Right. They're coming to the end of a long, very interesting, very dense, but very tiring day for those who've been paying attention. So down to 12, we've got that entertaining speaker at the end of the day, Professor Huang Yiping from Peking. Just a month or two ago, showed me around the new campus of the National Development School, a beautiful environment, lovely buildings, built on the edge of the summer palace with the contributions from Hong Kong entrepreneur. So not only is Yiping a great economist who's made terrific contribution, but he's now a great builder of an academic institution. Yiping been a terrific contributor in his early days here, more than 3.5 decades ago, or more, and it's always been right at the frontier of the important and interesting development. His early work in the first few years was on rural development, agriculture, and the development of the township and village enterprises, which was so important in that early stage of Chinese development. And then through the 90s, China geared up for that great industrial transformation, which changed the world in the early 20th century. Started to work on that and the macroeconomic implications of that. And then was one of the people that first noticed the big transformation a decade into the 21st century, the turning point in Chinese development, when Chinese labor started to become scarce and forced structural transformation. And then for a long period, he was a leading figure in analyzing the macroeconomic developments in China, including twice from his chair at Beida, being a member of the Monetary Policy Committee of the Bank of China. So it should be no surprise to us that as the digital economy emerged in the frontier of Chinese development, at the front of that work would be Professor Huang Yiping, a pioneer of that work on digital finance a decade and more ago at Beida, and now to tell us how it's all coming together and what impact it will have on the whole economy.
It's always nice to hear your professor saying something positive about your work. Even though when your professor is sitting in the front line, it feels like going back to the older days when I first made my presentation. I had to read out from my notes and I didn't really understand what other commentators said about my presentation. We already heard some materials and some of our work in the field of digital finance. So what I'm going to do, I'm not going to repeat what they just said earlier on. I will try to present some of my own research in the field, but I'm not going to go very academic. Today I'm going to tell you a storyline about what happened in this space. Ross just mentioned about our work. In fact, 10 years ago, we established this digital Institute of Digital Finance. And the last weekend, the passing weekend, we celebrated the 10th anniversary of our institute. And we had a packed room, like about 500 people attended for the session, which was quite interesting to look back what we did, and the sharing was one of the important team members. The index, which was referred to a couple of times. I started the project, but unfortunately, I did not put myself as a co-author of the paper. So now this is in the financial academic world in China. This is the highly cited paper. Unfortunately, I could not put it on my CV, although everybody refers it to as my product. But anyway, it was a very productive way of doing it. I still remember the first time when we started the institute, I was asked to do it together with N Group and the CF40 and the PKU. I asked some of my colleagues if they would like to join me to do some work. And they said, well, we'd love to, but we know nothing about this sector. I said, well, that's a problem, but nobody knows. So if we spend the time to look into it, we might become experts in the field. 10 years later, I would say the leading author of the index. In fact, now he was my first postdoctoral fellow at the Institute. He's a very famous scholar now in China, a professor at the Shanghai University of Finance and Economics. In fact, like a very wide range of scholars emerge. I always encourage these students that if you want to do something exciting, this is what is happening in China. And in fact, if you start with your research in the field, you have the opportunity right to get into the frontier because nobody has done work before. So that was a very interesting process. I would also refer to the book we did together. And I think I forgot, Sherry also contributed a chapter. And somebody asked her about the question about, I think Ross asked it about international comparison. In fact, we just published a textbook, and Sherry wrote the first chapter on international experience of digital finance. Somehow, surprisingly, she didn't mention that work. So some of my work would introduction will be based on some of the work we did together. But I will show you first the Ant Group, the experience of the Ant Group, which is probably the largest digital financial company institute in China, and possibly also globally. They have started with Alipay in 2004 and then gradually evolved. And this is not a very comprehensive business. I'm not going to get into it, but I also will mention that I have maintained, well, our institute was partly supported by the Ant Group, but their main contribution to our academic research is not just like a fixed amount of fund they provide every year, but most importantly, they open up their data for us to do research. That is quite unique. Nowadays, they don't just support the academic research of our institute, but they also try to support other academics to do research. So that was very interesting. I think Xiaobo already briefly showed this picture, but I feel that the quality of my maps are probably better than his. So I'll show you again. This is the index I mentioned earlier on, just shows the comparison. We divided the municipalities in terms of digital financial development every year into 4 groups. Most advanced, the red, and then orange, then yellow, then green. In fact, the report showed these 2 maps to our former premier, and he was very excited. Basically, the comparison, that's 2011 and this 2022, just shows the big change over the years. And the simple takeaway is rapid convergence of the relative development. In 2011, there was almost nothing in the central and west China, and now it's catching up very quickly. He actually specifically mentioned this line, the Huang line. That was, I think, economic geographer in the 1930s. He found if you divide China into 2 parts by this line, the size of the land space were roughly similar on 2 sides. But to the east of the line, it had like 95% of economic activities or population, only 5% to the west of the country. And the former premier was very excited because he saw economic activities actually moving across the line. There was a hope that financial services would improve on the West China, and maybe the economy could grow faster. Later on, some of my colleagues also did the research jointly with IMF, and they found some evidence that positive changes are happening. Digital finance in China started by Alibaba. And the initial reason was they set up the e-commerce platform, and they want to do business with anybody from anywhere in China. That was a brilliant idea. The only problem is you can't close the transaction, because if you have somebody show a product online and some other person will look at it and like it, but the question is, how do you close the deal? Does the supply send the product first, or does the buyer send the money first? Basically, there was a lack of trust between the two parties, and you can't close the deal. So eventually, this is a long story, but eventually Alibaba decided to do this Alipay. The business model was originally modeled from PayPal, but they implemented the online and did it very well. So that's the beginning of the digital finance in China. And the point I want to make, that's applicable to all other businesses that you'll find later on. Whenever a new business model or product was discovered, it was designed to solve a fixed problem. There was a problem in the economy, and you're trying to do something to overcome it. And I think that's the history of digital financial development in China. Once the e-commerce, the shops get their businesses going because of the Alipay or mobile payments, then the next question they had was, well, what are we going to do if we lack of funding? So the question is, can Alibaba lend some money to these online shops? Initially, they worked with the bank, and the bank said, fine, you can recommend a list of your good shops or SMEs to us, and we'll go through the list and see if we can provide some loans to some of these the shops. Eventually, what happened was Alibaba repeatedly sent a list of what they think good shops, SMEs to the bank. The bank just rejected everybody, because if you're using the traditional approach to assess the credit risk, nobody would meet the standard or the requirement. And that's why then Jack Ma said, well, if you can't do that, we'll do it on our own. So they set up a microcredit company, which was registered in Chongqing, but it's eventually doing businesses everywhere. One of my main research in the past for 10 years was looking at what we call big tech credit or big tech lending. On the one hand, you utilize the platform to attract lots of users. Once they're on they're using your services, or whichever, e-commerce or on the social media, whatever, they already are a part of your platform. And then you can try to find their digital footprints. Once you accumulate big data combined with algorithm, and you can do credit risk assessment. Because of the time constraint, we have lots of papers, but basically now you can use big data online and the AI or whatever algorithm, trying to conduct the credit risk assessment and start to make loans. Two things stand out. Number one, the number of the customers you can serve on a platform becomes just like unimaginable by the traditional bank. So, for instance, the My Bank set up by Ant Group. In the first year, they served 5 million customers online. Their total staff number was only around 1,000. So that, I guess, just gives you the idea how digital technology can facilitate the new businesses, efficiency, and also risk control. In fact, the non-performing loan ratio for the online credit, online lending, is much lower than the NPL ratio for the banks for similar types of the loans. i.e. for SME loans. We also recently did another paper trying to look at not just the data is useful and the algorithm is useful, but we also try to look at when a person, a credit officer was making a decision, you often find a discrimination or bias, especially when somebody walks in and you just have some idea in your brain and you will make some biased decision. That's quite normal. And what we're trying to find is when we replace it either with data, big data, or with algorithm, which can help reduce the bias. Our finding was data doesn't help in reducing the bias, but algorithm, i.e. the machine that makes decision use the data can actually reduce the bias. Now that result, I think, is data driven. The result might be different if we're looking at the other studies, but it's useful to compare which is more useful and more important in driving the result. The other thing that happened was once Alibaba had Alipay and then had a microcredit service, the next thing they find was, well, you actually find that the individuals using Alipay wallets, they have some small amount of money left. They want to make investment, but they couldn't not invest, because if you leave the money with the bank, the return is a minimum and basically it's nothing. But if you want to make an investment, they don't reach the minimum requirement. And so the question is, can Alibaba do something to help people to make small amount of investment? And that's the creation of what do we call it, Yiping, the money market fund online. It's linked to Alipay. And you just move your money, small amount of money into it, and you'll get an investment in a money market fund. Surprisingly, they created this Yiping in June 2013. In that market, there was suddenly like a money market crisis, a shortage of liquidity, and the interest rate went up to almost, well, close to 10%, not 10%, but like 8% or 7%. That suddenly became the best attraction of somebody who can use an online Yiping. You move your money into that small account and you get like 7-8% of return. Now that rate was quickly normalized as the PBOC injected more liquidity. But that shock, like, was the best advertisement for that product Alibaba cannot dream for, but that happened. So in fact, the Yiping and the Yiping was affiliated with the Tianhong Investment Fund, which was a fund nobody knew about it. But within 6 months, so maybe 8-10 months, it became the largest investment fund in China. And even the regulators start to worry if they might dry up all the liquidities in the rest of the market. So they asked Alibaba or Ant Group to slow it down. And they had to slow down. But I guess that just shows, number one, there was really no investment tools available for individual ordinary people. And number two, when everybody can put a little bit amount of money in the wallet, the total size is just gigantic. It became the largest investment fund in China within 10 months. And obviously that is still going on. But we did another study, and group obviously went further to look at what they can do to help the individuals. And here we also looked at the two tools they use. Number one is called Banglito. Banglito is basically automated investor. They just made a decision for you on your behalf. And number two is called Zishaobao. Zishaobao is more like an advisory check. If you have a question, you can ask, and it will give you some ideas. But you, by yourself, make your own decisions. So what we found was Bonito is still not very efficient, although we found here in terms of risk-adjusted performance, it also improves the performance of your fund. But overall, the impact is not still not very exciting. I show this chart. The chart is from Professor Garnaut, I think. What they're trying to do is they show the wealth distribution among households in China and other developing countries compared to the developed world, like the US and the UK. The simple takeaway is if you compare the distribution of wealth in China, the lowest, the poorest household and the richest household, their proportions of wealth are not too different from those in developed countries. But really, the lagging part was for the middle class. These people saved a lot of money, but the wealth is not like a similar. The share of the wealth is not similar, and I think the main reason is they're not getting a good investment return. So they're not getting a good investment advices. So this is why robo-advice is something. Even when we started this study, I thought that this would be the next biggest breakthrough for investors, because if the Chinese middle class households can get the kind of private bank services for rich people from the traditional financial services, then I think the quality of wealth management can go a big step forward. Unfortunately, we are yet to see breakthrough. So either because people don't trust it, or because the models are not advanced enough, or because even if you have a good model, you don't have a rich financial market. You can't really, you don't have enough financial products to invest. So there are many reasons this is yet to see a breakthrough. But obviously there are some other things happening, like you can use the AI technology to compile an investor or consumer sentiment index and so on. These things are happening, but I think they're still at relatively early stage. So I gave you some examples of the innovation happening in China, and these are very exciting. In fact, lots of international organizations are also very interested in it. And one of the studies we did with BIS, and when we think about the lending to the SMEs, and you probably will know, most of the Chinese banks lend money to SMEs by taking collaterals from SMEs, because you don't know how to assess their credit risk. Then the easiest way is to take the house of the entrepreneur, then lend the money. That's a very common practice in not just China, many other countries. Ben Bernanke and his co-authors found that when you use this collateralized loans, there is a special mechanism called the financial accelerator, the collateral channel of the financial accelerator. If you extend more loans, housing price will rise, then credit supply can further expand. In the other direction, if housing price decline, you squeeze the credit supply, and the housing price will decline further. So you might end up in a financial crisis. This was the basic idea. But now remember, in the big tech lending or digital lending, we don't look at the housing, we look at the data. When you use data as the key elements for lending decision, this financial accelerator just disappeared. And we look at the elasticity of the different lending, basically confirm that housing price is no longer a key element for the lending decision. That BIS chief economist became very excited. He cited our finding even before we wrote the paper. And so he actually had a paper cited here, but that's not in the paper we actually studied that elasticity. That's another paper we looked at how do machine learning and non-traditional data affect but anyway, what I'm saying is the new lending that changes lots of ways in the business operation. but it might also affect the features of macroeconomic or financial stability. And these are the things that we need to look at. There are also issues with the peer-to-peer lending. I'm not going to get into it. This became, well, it was so popular and so hot for a while. And at one point, we had more than 6,000 P2P lending platforms in China. But after a couple of years, they all collapsed. One simple reason was there was no credible credit risk assessment mechanism created. And so it's kind of like a Ponzi scheme, and sooner or later you would collapse. But watching this process happening in China, it's also a bizarre experience. I have to say, I myself went to the CPRC a couple of times, telling them whatever you do, if they involve financial transactions, they need to be regulated. The head of the section told me the state council's policy direction is deregulation. So he was in no position to introduce more regulation because this was not a time. But anyway, so this is a good thing for us to look at. I want to briefly mention one thing that is happening in China, and the policy direction is quite unclear at the moment. That's related to digital currency. Now, we can look at the digital currency in different types. The crypto is one, stable coin, and the central bank digital currency. In 2017, the government said, well, we don't like the cryptos because they could introduce lots of risk into China, mainly because we still have the capital account management. We still have lots of like anti-corruption responsibilities, and there are many other issues we need to deal with. If cryptos can be freely traded, by the way, I should say, according to some data, at least 70 or 75% of the crypto assets globally are owned by Chinese. One way or the other, according to the measure, it's a big amount, and the number might not be accurate. So the authorities were worried, so they basically banned the trading of cryptos in China. Obviously, people can still own cryptos overseas, but not in China. And I thought that was a reasonable decision. At the time when you don't have ways of dealing with the risk, then probably excluding it was a reasonable thing to do. And that's what happened. And the government tried very hard to develop the ECNY, the central bank digital currency. The problem is we already have mobile payment, like Alipay and WeChat Pay, so successful, so smooth everywhere. And then the central bank start to push on the ECNY. What is the additional advantage of ECNY as a payment tool? In fact, nobody could actually tell. Well, I mean, it's useful, but what is the additional benefit? So that's why today we still haven't seen ECNY circulating. And the PBOC is still working on it very hard. And now they try to change some features of it. Like before, they said there would be no interest payment. And now they're thinking, well, maybe we'll pay interest from the 1st of January 2026. Some of it will be changed. But I think the big question is not ECNY or crypto. The big question we face today is, what are we going to do with the stable coins? Because it looks like stable coins are going to rise very rapidly. US, Europe already had their own regulation, policy framework. Even Hong Kong had a policy framework. But the question is, how are we going to deal with it? I think the policy position actually shifted a bit during this year. At the beginning of the year, some senior officials thought, well, this is something new in the financial innovation, and maybe we should actively participate. But around the summertime, the attitude suddenly turned back. The current position is that we're not going to accept it. So we're going to ban whatever can come to China. That is essentially the same policy position started in 2017. And I was told that the two main concerns, number one, we don't have good ways of dealing with the risk. And so the question is again the same as in 2017. If you don't know how to deal with the risk, then the easiest way is first to exclude it. Second, somebody speculated that PBOC might still have a vested interest in pushing the ECNY, because if stable coins come in, it might just further squeeze the room for the ECNY. But anyway, so that's the current position. My own view is that I'm very sympathetic about the risk problem, but the risk question actually changed. Recently, we did a study just to show previously the risks in the crypto market and the traditional like US dollar asset market are completely segregated. They're not correlated. But from 2019, the risks became like correlated. And so what we did in this study was to find out what was the key change that made the two risks now connected. And they are, at the moment, there are probably two reasons, two mechanisms. Number one mechanism is from 2019, all the transactions in the crypto market now use stable coins. Before, they used cryptocurrency like the Bitcoin and so on. So now, stable coin is connected to a sovereign currency or a related asset, which means the channels now already are like open. The second reason, which was what I was told, is that some traditional investment funds now also include some crypto assets, which means the two-way risk transmission is happening at the moment. So my point is, well, if you are the reason why you want to exclude the crypto is because you worry about the risk spillover, and that's understandable. But the problem is, even if you exclude even the stable coins or cryptos, the risks could still come to China. And then what do you do about it? My own sense is that we probably should be careful about the potential risk. So my proposal is a three-step approach. Number one is we probably want to be careful about eliminating or controlling the potential risk coming from the overseas market. If we are not yet ready, we need to take whatever measure we can to stop the risk as much as we can stop the risk at the border. But the second point, which I think is also important, is engaging in the stablecoin market that could bring risk. But even you don't engage, it also brings risk, as I said earlier on. More importantly, development of the stablecoin market will also have implications for two things. A lot of the new financial technologies, like the tokenization, like the blockchains, like distributed ledger, and so on, these technologies are actually useful for traditional financial services. If we stay out of it for a very long time, we're not going to have this more advanced technology. We don't even know. Now, I actually have a lesson myself. As you know, we've been doing digital financial research for 10 years. Whenever I go overseas, I always claim very proudly that we are at the frontier of financial innovation and financial research. But nowadays, I gradually feel less and less confident, because people talk about the cryptos, and people talk about the Web3 and so on. We don't do research, and because there's no innovation in China, and that means you're actually leaving the frontier further and further. And I worry about the same thing for the Chinese financial sector. Second, I think the main usage of the stable coin is probably to form a new cross-border payment system. If the stable coin, and we know the stable coin is becoming even more dollarized, because the share of the dollar in the stable coin market, somebody told me, is about 99%. So if we hope that we want to internationalize RMB, And if somebody does it, forming a new cross-border payment system, and we don't participate, suddenly we become an outsider of that new payment system. That I think will be very, very unfortunate development. So how to do it? And I think we probably should be careful. Just to quickly, number one, I think as I said, the first step was to prevent the risk spillover from overseas. The second is on top of that, we probably should think of ways of experimenting it, but without significantly engaging domestic traditional financial market. And one way of doing it is try it in Hong Kong, offshore RMB market. You can do whatever you can in Hong Kong. Hong Kong is an international financial center, but still try to segregate from domestic system. You can also experiment domestically if you use a closed system. But the third approach is I think we should engage it. As I said, PBOC might be worried that if we start with stable coins, the room for ECNY will be further squeezed. That's a possibility. But I think there are also ways of finding the situation in which actually stable coins and ECNY could coexist. You can imagine if a stable coin becomes a new cross-border payment system, it will mainly be for smaller amount. And at the same time, you can use ECNY between the countries on big trade and investment transactions. So I think actually it's quite possible. Just to finish, Russ. I think, even though this has been going on for a long time, the first tool was invented in 2004, as I said. So it's more than 20 years. But most people like to identify 2013 as the year one of digital financial services. But whichever, 10 years or 20 years, it's been a long time. And I would say China has been a leader in this innovation, not necessarily in terms of technology, original technology, but application. Because of China's size of the market, because of its more advanced digital infrastructure, and the government also adopted a much more tolerant approach because they see the real value. Governor Yiping came to deliver a keynote speech last weekend at our 10th anniversary, and he said a number of things the central bank did, but I think one point he made was they really see the true value of financial inclusion of these new financial innovation that the traditional financial institutions were not providing. So that was very, very important. Somebody this morning asked what would happen further if the AI is applied, and I didn't have a chance to respond. AI is already a part of this application, depending on how you define AI, because that gentleman was referring AI as just a large language model, but that's only a small set of the AI. The credit risk assessment, the algorithm, definitely is a part of the AI. AI has been widely used in financial institutions in China to improve the efficiency, to control the risk. So for instance, the customer services, the human customer services, 90% of them already were replaced by machines. That's AI. And the most financial institutions also use AI to prevent fraud. Identify irregular financial transactions, irregular, strange customers, and so on. So AI is already at play. But I think the point he made was important. We are still at an early stage of application of digital technologies, especially like large language models and so on. How they're going to further change the landscape of the financial industry, we do not know for 100%. And the things are still very dynamic, but looks like it's changing. And so the last thing I think is very important is now to catch up in terms of financial regulation. I think leave space for financial innovation is very important. But we also learn our lessons, especially in terms of the peer-to-peer lending. But I think that how to find the balance between the two, and we heard about the data policy, and China was also learning some lessons in it. Like initially we modeled on GDPR, and then suddenly you find there's no innovation, because if you protect the rights too much, then nobody can use the data and there will be no innovation. I think the good thing with the Chinese policy making is the so-called pragmatism. If they find it's not working, they move back a little bit. I don't know if we are at the best balance at this stage, but it's very clear. Finding the balance is something we still need to do in the financial space. But more importantly, I think going forward, this is the need for international cooperation. A lot of digital financial services are international by definition, especially with the ECNU, the CBDC, with the stable coins and so on. So how to promote the international cooperation? I don't know. The financial institutions and like the IMF, BIS doing their work, but we still need more effective coordination. I'll stop here, boss.
Thanks, Yiping. Maybe you keep swap and stay.
Okay.
Fine. One or two questions for you, and then we'll wind up. Please.
Thank you for Professor Wang's speech. I have one question. It's whether that private economy plays important role in China's growth. What is the performance of digital finance on the development of private economy, and how to make efforts, especially in technology innovation, and also what's the difference?
Your question is private sector's role in technological innovation or the role of digital finance in supporting the private enterprise?
The performance of digital finance on the development of.
Okay, I think overall, I mean, I don't want to take a lot of time to elaborate on, but I think Xiaobo, Professor Zhang, his study just showed that the digital finance was helping lots of SMEs. I mean, I forgot if he mentioned the private enterprises, but all the SMEs or even these informal sectors can be classified as private enterprises. So the benefit of that is very clear. I think the focus of most digital financial innovation actually serve the private sector.
We better give other people a chance. You think you're a very thorough answer. Next one.
Thank you, Professor Huang. My question is, you talked about the slow growth of the wealth growth of Chinese middle class.
Yeah.
Is this related to the insufficient supply of financial assets?
Yeah.
And what can we do in with digital technology?
Well, I don't know here if digital technology will be the key. I think the most important is through policy liberalization and financial innovation. Liberalization means we probably can liberalize the financial market, but we also can enrich like the type of products. So for instance, some people say, well, if you already have a stock market, what's the problem that you still don't have a good investment? But we know the stock market performance is so unreliable and nobody can use it as a prudent investment tools. What I think is the quality of the stock market needs to improve. And one very important part is to reduce the direct intervention into the market, let the market forces to play its role. But at the same time, we also need like a much richer set of the financial products. Like we always are very concerned about the financial derivatives. But the financial derivatives are very important part of your asset allocation. You can't just buy like the blue chip companies. You also need other products to be a part of. That's why I'm saying. So I guess a short answer to your question is we just need to grow the financial market both in terms of quantity and in terms of quality.
Become last question.
Very informative, very update. So apparently there's a problem. One problem is the very decentralized way of using stable coins and based on the blockchain technology. On the other hand, is the central bank's digital currency. So how do you reconcile? Is facing the big challenge with the PBOC. That's one thing. Secondly, as you mentioned, that Hong Kong's law allows people to trade stable coin. So that actually, if China doesn't move, a lot of investors will move to Hong Kong to the business.
Yeah.
So how do we reconcile this?
Well, I think I'll focus on the first point you raised. This is the reason why central banks all don't like stable coins because they find it's difficult to regulate. But I think we should recognize this is not something that central banks can dictate. They like it or they don't like it. You have USDT, USDC. One is regulated, the other is not regulated. Both are like moving very rapidly. But I'm somewhat more positive about the stable coins is because this is different from the Bitcoins. It's not like completely decentralized. In fact, the stable coins, the supply of stable coins is centralized because it's done by somebody to create the stable coin. It's a very centralized process. Plus, there are now actually technically, there are already ways of monitoring. For instance, you can look at where the account is located, what kind of transactions they're doing. So somebody gave me an example. Regulating stable coins, there are two models. One model is like you check into a hotel and the front desk knows who is in the room, but they don't know what you're doing in the room. But it's important you know who is in the room. The second kind of model is like a beach party, because the space is open. And you might see somebody just randomly jump in and to pick up a glass of wine. But you can identify, use a wide list, a name list, who can participate in that game and who should be excluded. So technically, I think there are ways of regulating it. Obviously, it's different from regulating a bank account. That's very different. But there are ways of doing it now. And as I said, the biggest worry is that if you don't engage it, it still will happen. And one day we will find that we are way behind the frontier.
Thanks.
Well,
Thanks, Yiping, for a very stimulating end to the day. And we've had a very stimulating day. It's been terrific, built around a close examination of the digital economy in China and to some extent the rest of the world. But that's taken us into all of the other issues in the economy, the big macroeconomic issues, the international strategic rivalry, the interaction with the trading system and the challenges that it now faces. We shall become. My suggestion is that you need an introductory chapter of the book for this conference that brings together all of these economy-wide influences, because I think we've had a tremendously rich discussion today. I haven't been part of a discussion quite as rich as this, and digging into the digital economy and its links to other parts of the economy. For an 80-year-old who's only been familiar with these things for the last quarter of his life, some of the discussion was a bit challenging. In Sherry's tables about differential use by age category. But then she gave the solution. She said, well, with multi-generational households, it's not so bad for the old people, but the young people can fix them up. Well, these days in Melbourne, the cricket or the football, unless prepared to stand in a single long queue for an ordinary ticket, you've got to use your phone to pay, and I always make sure I go with one of my grandchildren these days. In two of the presentations, and again with Yiping, we saw very interesting presentations on the regional disparity in access, how that is being reduced quite rapidly. The wonderful spread to the west of use of the digital economy. Well, the challenges of my age and the regional distribution came together for me a month ago. I mentioned that I'd been with Yiping in Beijing, and then I went to Shanghai. Well, Shanghai on those maps is the very peak of digital, and I had a wallet full of 1,000 and 100 renminbi from my last visit to China, and I could not buy a donut for breakfast, no matter how many being again. But luckily, I was accompanied by Yiping's daughter Amelia, who taught me how to use Waypay, and therefore I was able to buy some breakfast and felt very proud of myself that I was even able to give 50 yuan to a beggar. Because the beggar would not take 1,000 they know, but he was very happy to show me his QR code. So with the help from the intergenerational linkages, we can overcome even the interregional distribution challenges. It's been a terrific day on one of the big frontier issues of the Chinese and international economy. It's going to be a great book. I'm sorry I won't be able to be with you tomorrow, but I'll be reading all the papers and the book. And thank you, Li Young and Yisha, for pulling together such a rich program. See some of you for dinner, and all the best for tomorrow.